Enbridge is today's topic, and welcome back to another video. Now, if you haven't already guessed, yes, we're going to be looking at the latest annual report of dividends and taking those updated figures and plugging them into our dividend payout calculator and our DCF and DDM models to figure out if the intrinsic value of Enbridge has changed. Now, at the very end of this video, I'm also going to be adding the twist that I'm going to be taking the best case and the worst case of the intrinsic value models and figuring out what our return expectations could be if the stock falls, the stock increases, or remains flat by the year of 2029, and see what our average annual return would be. So if that interests you, definitely stay tuned. And if you're new to this channel, welcome, but definitely check out this video first because it's kind of the prequel to this video. So if you don't watch that one first, you're going to probably have a little bit of a gap of understanding as to exactly what we're looking to achieve here today. So let's get right to it. Just like the last video, I'm going to be starting on the highlights page here within their slide deck, and I just want to draw your attention to the very top line on how they mentioned that they exceeded by midpoint of 2023 the DCF share guidance. So again, I highlighted it so much, and I'm going to apologize again for saying the word confidence in this video, but again, as we are doing predictive analysis or trying to figure out where the value of Enbridge could be in the next 5 years, it's important to have confidence behind what you're buying into. Now, I did forget to highlight this in my last video, so I'm going to show you guys today, but now you'll see here it says 18 years of consecutive guidance achievement. Again, based on confidence. Now, this is why there are blue chip companies. Enbridge is a blue chip company. They're reliable, they're consistent. They're, what they predict is what usually will happen, which is obviously shown in the last 18 years. So as a shareholder, you have a really good expectation as to what your return should be based on what they're telling us, right? So again, very important that having that confidence behind them is obviously very key. Moving along in their slide deck. Now this again, I'm not going through like all the individual numbers of their annual report. I'm just going to be touching base on the highlights. I personally have gone through it myself, but I'm just kind of bringing the attention to you guys as the too long didn't read. So I hope you guys appreciate that. Leave a comment below if you would prefer me to go through the fine details, but I'm going to guess people rather the video to be less than more. So but again, leave a comment below as to what you guys prefer. But I'm going to draw your attention here to just the center of the slide of this one and how they have an aim of DCF payout range of 60 to 70%. Now, for those of you who do not remember what DCF payout is, a DCF payout can include dividends, share buybacks, debt repayments, or any other form of cash distribution to the shareholders, okay? So 60 to 70%, as per their latest report, they are sitting in around the 65 percentile, which again is awesome. They're not close to the top of their range. They're not, so they have lots of room for improvement. So again, just wanted to highlight that. And again, back to the word confidence. They are now having 29 years of consecutive dividend growth. So again, if you're a dividend investor, maybe you're close to retirement and planning on living off some of this dividends, it's always super crucial to know that you're buying into a company that has 29 years backing them as increased dividends is awesome. Because again, if you're living on dividends and they aren't increasing it, well, guess what? Inflation is still going up. So you don't want your living, your income to be eroded by the cost of living. So again, very important to see. And again, this is again why they are a blue chip company. Moving along to the 2024 business guidance section of the slides, you're going to notice right away compared to the last video, they don't have their dividend payout on here, which kind of like struck me a little weird at the start. But if you really think about it, the dividends is included in the DCF per share. So you'll notice here that the DCF per share still does have a 4% compound annual growth rate, which is what they had indicated prior as well. So that hasn't changed. But like I said, they aren't reporting their payout ratio or their dividend payment increase on this slide. But again, for this sake, I'm going to just assume that if they're predicting 4% in the compound annual growth rate of their DCF, we can see somewhat similar in their dividends as well. Moving along, just before we kind of get to the dividend and DCF and DDM models, I just want to highlight on this last slide, I promise, you'll notice how their DCF per share came in at $5.48. Now, if you remember in the last video, their predictions were between 5.25 and 5.65. So I feel this is very strong. They came in with great numbers. Now, if you do remember, I did assume that their numbers were going to be lower, on the lower side of their predictions versus, closer to the top. So again, very satisfied with this. It's actually kind of funny leading into the earnings call. If you watched the community post, you'll notice how I increased my contributions to Enbridge for the anticipation of the stock price going up after earnings. And of course, because I did that, they went down. So you guys can, blame me for that. I apologize. So. All right, so we're going to be starting with the dividend payout ratio. Now, in the last video, I highlighted how places like Yahoo Finance show Enbridge pays 125% payout ratio, which is not true. And if you want the explanation why, you're definitely going to have to check out the other video that I have mentioned previous to this one. So I have taken the updated figures from the latest annual report, and the new dividend payout ratio comes in at 53%, so much lower than 125%. And again, this is on their dividend payout ratio, not their DCF payout ratio, which is at 65%. Moving into the DCF intrinsic value model, I just kind of want to highlight because I did change a few things and I just want to explain myself. Now, in the previous video, I didn't indicate on how I get the free cash flow multiplier. So I'm going to explain this here right now. So to get the free cash flow multiplier, what we need to do basically is take the free cash flow over the past number of years and divide that by the market cap, which then gives you the multiple, right? So what I did in the first video is I took the average and I used that number. Now I'm making a slight alteration in this video, whereas in the last video, I took the latest free cash flow and I used that at the very top, which was right here. But I'm kind of feeling that, you can see how Enbridge doesn't always have a consistent free cash flow. So it could be, not proper to use the latest one because, let's just pretend, it was 2021. The figures would be drastically different if their free cash flow was only 1.1 billion compared to, 6.4 or 9.3. So what I did in this video is once again, as I took the average, I feel like that's the better method on how to accomplish this, which then comes in at the 6.5 billion mark. So that's the number we're going to be using today. But again, I just want to be transparent on how I'm figuring out these numbers. Again, these models, they're manipulated in so many different ways that everyone kind of has their own best practice, but this is the way I'm doing it today. And for those of you who are new, again, these are very simplified models. You can do a DCF model that takes months to construct, but we're not doing that here. But that's why we're going to be using a margin of safety. So when you take all that information, we are still going to be taking the 4% compound annual growth rate of their DCF guidance. And the new numbers now indicate a $75 intrinsic value of Enbridge. And with the safety percentage built in, we're at $60 per share. Now, again, we haven't done the DDM model yet, so don't just go and rush out and buy, Enbridge stock. You got to wait here. Just hang tight, you guys. So going into the dividend now model, what we're doing is, again, I'm actually just going to use the 3%. This was on their guidance prior to the latest at 3%. Now, their DCF guidance was also at 4% when their dividend guidance increases were 3%. So I'm going to use 3% still. There could be an argument to use 4% or maybe less. It's kind of, again, all up in the, it's all with a grain of salt, right? But I feel 3% is pretty safe because I feel like that's going to be the bulk of their DCF payout. So we're going to use 3%. So the numbers don't actually change all that much, but it comes in again at the intrinsic value of $52.29. And they're with the safety margin built in coming in at $41.83. So for a combined average of $51 as an intrinsic value of Enbridge. Now, again, if you remember from Morningstar, they did show on one of their latest reports that Enbridge was a buying opportunity, and their predictions were in the plus $50 range, which line up really close to what our intrinsic value is here today. But to move things a little bit further, we're going to be taking now the averages of the intrinsic values of a kind of a best case and a worst case. So let's kind of get right into it. All right, so I actually kind of made a slide. I thought maybe it was a little bit better for a visual effect. So again, we're going to be assuming we're buying Enbridge today at $46. And I kind of have three different predictions. Obviously, one that's with a stock that falls. We're going to have the stock that remains flat. And we're going to have the other one being that the stock price increases. So starting at the top, stock price at $41 by 2029. So you bought it at $46. It is now dropped to $41. So that would indicate 11% loss on the stock price. But don't forget, you still get that 8% annual dividends. And now the dividend isn't always safe. They could, obviously stop paying that dividend. But in this case, with the confidence that we have behind Enbridge, we're going to assume that even if they didn't increase their dividends and we still remain on getting that 8% dividend payout, that would mean after 5 years, our actual total return would be 5.8%. Now, I don't think that's anything to be upset about. You lost 11% on the capital appreciation of the stock, but with the dividends, you still walked away with 5.8%, which I feel is very good. So the other option obviously is the stock remains flat. So you bought it for $46 and by 2029 the stock still remains at $46. Now this is very obviously quite easy to figure out, but with an 8% dividend, obviously your total return with dividend on average per year would be 8%, which again, 8% is nothing to laugh at. I feel like that's a very acceptable. I would be very happy if I bought Enbridge today and they remained at $46 by 2029 and I capitalized on that 8% return. And best case scenario, with our intrinsic value coming in at $51, that would indicate a 10.87% capital appreciation on the stock for an average per year of 10.17%, which I would be very happy with if I bought into Enbridge today and sold by 2029. So I'm definitely interested in what you guys think. Leave a comment below. Are you buying, selling, holding? Are you still kind of on the fence with Enbridge? Like I said, I would be very interested to know. And anyways, I hope you guys enjoyed this, and I'll check you guys later.